We're going to be talking about a very important topic. Nothing exists without liquidity on chain. And we're going to be chatting with a range of incredible experts who are going to be bringing liquidity to Bitcoin directly, the mother chain. And to host this panel, we have, once again, from RunesDex, Mr. Erik. Please come join us, Mr. Erik Oydeutscher. Really appreciate you being here today. I would also like to welcome to the stage Mr. Sebastien Davies from Aquanow. Welcome, welcome, welcome. We also, of course, have Mr. Spencer Yang from UniSat and many, many other companies who we will tell you much more about. And sorry. We're cutting it close here, ladies and gentlemen. And last but certainly not least, we have Lee from Voy Finance, I believe. Lee, do we have a Lee in the house? No, okay, we got a lovely trio panel. So Erik, I'm gonna pass it over to you, and we're gonna talk about, actually this is a perfect two people to be doing this, to be perfectly honest. We're gonna talk about liquidity on the mother chain. Let's go.
Thank you for the intro, David.
Yeah, let's get into it.
Yeah, okay, last panel of the day, obviously the biggest panel of the day. How about you give like a little introduction of yourselves, like adding to what David already did? Yeah, can you closer to your mouth a little bit?
Hi everyone, Spencer here, one of the core contributors for Fractal Bitcoin, partner at Block Space Force, and also advisor and like I guess I work on random stuff for a lot of like companies, like for example UniSat, SatLayer, and also Alchemia. Yeah, so like I've been personally in the Bitcoin crypto space for about 8 years now. Really enjoyed like sort of building for the users. Used to run CoinMarketCap, used to run products for Coinbase as well, and then through a lot of these work, and also like early member of Kobo back in the day. So it's one of those things where like it's really just been very, very enjoyable working for the Bitcoin retail audience. That's kind of my bread and butter, like really helping retail audience kind of succeed. But that being said, because of work reasons, through the various companies, also have to get involved with institutional users, audiences, and so on. And yeah, looking forward to sharing and learning more from this panel too.
Fantastic. Yeah, no, I feel oddly maybe young in a way, in the sense that I have less experience than probably everyone in here. But came into crypto a little bit later than most. Maybe kind of got hit by the bug in 2020. Had a little bit of extra spare time on my hands at the pandemic, like most folks. And yeah, like I used to work at a bank and had a good job that like paid me to be engaged on that kind of stuff. And then some friends were like, "Hey, you really got to look at this stuff that's happening over here." And was like, "Well, actually, this is quite cool." So Aquanow provides like trading and payments APIs, as well as like consulting services for traditional financial service businesses who want to enable crypto on their platforms. So, if you use the analogy of like Web 2 to Web 3, we're probably like Web 2.2, helping people along the journey. And I actually think it's a, maybe not the most, it's a very noble task, I think. It's not like always the sexiest one, but like, we really help a lot of like robo-advisors and banks, with their first kind of initial crypto journeys, which oftentimes is just like buy, sell, hold crypto. And then, that helps people get onboarded and then can kind of go from there. But yeah, have a capital markets background and have a lot of, thoughts about the general topic of liquidity, and happy to be here and sharing with you guys.
Very interesting, both of you, of course. UniSat, one of the first autonomous wallets, super interesting to have you here. And super interesting to have you here describing yourself as like somewhat of a newbie with more capital and liquidity experience, from like fiat markets. Do you guys think we have a liquidity problem?
I can go first, I guess. I think we absolutely always have a liquidity problem, right? It's one of those things where you can never have enough liquidity, and liquidity begets liquidity, right, for the most part. But like to put it into context, right, I think at different parts of the crypto market and Bitcoin market today, there's like liquidity that's very concentrated around a few things, right? Right now, if you go to like Binance Futures, Bybit Futures, whatsoever, you can see like there's a ton of liquidity at the derivative side of things, on the spot side of things as well, across Coinbase and whatnot, right? But that being said, a lot of the liquidity when it comes to a lot of the other alternative assets on the Bitcoin side of things, whether it's BRC20s, runes, ordinals, and other things, is kind of lacking. And what I mean by that is really like a market pair liquidity between Bitcoin and those assets, right? Or even those assets against those assets as well, right? And to put it into perspective too, it's really about how do you have enough like market participation and also demand for buying and selling. And I think that is like, maybe it's the venue side of things or infrastructure or technicals. I think a lot of our builders over here in the ecosystem have been doing a lot of work to try to make that happen. But from a trading perspective, I think liquidity is still quite lacking. That being said, I think there's also like some cool protocols that are trying to unlock additional liquidity and usage of Bitcoin for other purposes, right? For example, like Bitcoin staking, like Babylon and so on. It creates like alternative use cases of Bitcoin beyond just buying and selling, speculation and so on, or even like just doing other things, right? So I think that's kind of interesting. It's another new source that has come into the Bitcoin space recently. And then maybe even beyond that, like liquidity, like even like looking at the fiat markets, a lot of people actually that don't really talk about so much is the mining side, right? Where a lot of liquidity of fiat actually goes into buying these like mining rigs, mining hash power, mining farms and so on, and then turning that into essentially almost like a durational DCA into Bitcoin, right? By mining this Bitcoin for a while, and of course protecting the network in some ways. So I think institutional liquidity, to put in perspective, I think is obviously lacking. It can always be more, but it's quite good at certain levels, right? And concentrated in certain products.
Awesome. Yeah, I guess I can add to that, like maybe on two things that are a bit disparate, but I think both relevant. I guess like on the fiat market side, I think expanding different use cases, for Bitcoin is one thing, and then expanding into new trading venues is another one, right? Like we saw with the ETF launch, for example, right? Like what that does, and what will happen when you can settle in kind will be even more like directly observable of this. But at the end of the day, every time there's like a buy or sell of like a paper contract of Bitcoin, eventually that trickles down to like something that happens on chain, which involves like which begets liquidity to your point, right? And then what you're starting to see is a lot of people who would have liked to have participated in things like the basis trade, for example, couldn't do it because they were not allowed to. Now that might change through regulation, which is fantastic, but even just being able to do that with like with an ETF and a CME futures, like there's like, I can tell you right now, some of the most conservative bank treasuries are doing this right now because they can. It's a great return, and they couldn't do it before. But at the end of the they're swapping like ETF contracts and ETF certificates and futures contracts. But at the end of the day, those hedging activities and then the settlement ultimately will involve Bitcoin. And like as the markets evolve, that'll be direct drive to Bitcoin, which is going to add liquidity even more, which is fantastic. And then another thing that I think different but also very important to think about here, and something that I'm directly involved in, is like using Bitcoin as like collateral. Right, like this is a pristine asset, $1 trillion plus, and growing all the time. Macro asset with like $50 to $70 billion traded liquidity every day, like very sought after kind of like collateral, and a lot of places won't accept that as won't enable you to like access liquidity from that. And I think that people who are able to step in and provide like kind of private credit or margin credit in that instance will enable like additional liquidity for maybe some other use cases, right? Where it's like, I have a Bitcoin, I don't want to like sell it because I love this thing, I think it's going higher, but I can actually like tap into its collateral value to then go do stuff like ordinals or whatever it might be, and explore some of these kind of more peripheral use cases of the ecosystem.
Well, you have been touching into regulation now, both. Do you like, to how much plays regulation into the barrier of entry for these liquidity providers currently? And do you believe that regulation, like how do we actually lower that barrier for institutional liquidity providers? Because as RuneStakes, obviously, we're like looking into that. We want to like increase our TVL, and we are always trying to like invite users and especially institutional investors to lock down some TVL because the returns and the rewards are really, really great. It's just either regulation or something else that's currently still keeping them from doing so. So what do you guys think on that?
Maybe I'll start off on this one, but these institutions by nature have to move very slowly, right? Like it's kind of like they have these licenses which are kind of like a ordained moat to be able to do certain things that they're very coveted. So they're not trying to do anything that might risk that, even though the returns might be fantastic. So I mentioned before that there are bank treasuries that are doing the basis trade by selling CME futures and buying the ETF, right? Now they are limited to maybe like 2% of risk-weighted assets, but both the long and the short there even though they offset each other, in the eyes of the regulator, that actually counts as 1 and 1. So they can actually only do that trade like half as much as they'd like to do, and that's kind of weird, even though they offset. But this is kind of like how early we are in educating the regulators on this kind of thing, and that's just using the CME and the ETF, which is a lower return than if it could do like something like a perpetual versus like owning the spot, and so it's a huge hindrance. And I think like we're very early in that, but like I also think it's like an underappreciated turn of events that's happened in the last little while, where the warming of some of the larger regulators to this ecosystem, Bitcoin in particular, like that's a huge sea change. And there's a lot of people on the sidelines who are like kind of ready to get involved, whether that be directly like trading, or like I said before, like providing liquidity in the form of lending, where I'll mention a company that like is not here at all, but like Ledin, for example, right? They're doing like $100 million of loans a month, and there are regulated financial institutions that they start to see like, oh, SAB 121's been repealed. That's interesting. I might be interested in trying to like provide credit here, and like that kind of activity starts slowly and then has a cascading effect, and I think that'll be just like provide a massive tailwind to the industry for a long time.
Yeah, that's an amazing perspective. Yeah, I think like the way that I think about regulation, it's that there's a few layers of that are really helpful, right? One is I think recognition of like Bitcoin and this like digital assets as like property rights, or in some ways for individuals. And by nature of that, sometimes a lot of the institutions are in some ways like large individuals in some ways, right? That could be interesting. I've seen, of course, many countries actually start having some of those like recognition of that. And then, of course, in relation to that too, then I think like a lot of innovation I've seen in that space is also kind of like pushed by people like yourself, who kind of maybe come from traditional finance and so on, who kind of understand how those structures and those institutions run, and then putting some of these things that we are doing into those frameworks that are essentially built for like a different asset class altogether, right? But at the same time, because these organizations and these individuals are speaking the language of these frameworks that are drafted in the first place, then you're able to essentially make it kind of mold well. For example, even things like custodian laws, banking, like what does it take to be a bank that holds crypto, and then to your point about how you can recognize assets and so on. A lot of these like changes take a bit of time, and I think like as long as there's more movements in the right direction, that is always good, right? What I've seen also recently is also, of course, in the US, there's obviously not a lawyer, but there's also this like change of different administrations of like, of course, the government, but also like the SEC commissioners and so on. And that also resulted in many of these reactionary changes along the way, where like even like yesterday, the SEC published this notice that, hey, meme coins of a certain category and so on are deemed not securities, right? So I think more guidance in that regard makes it a lot easier for practitioners, exchanges, or anyone, right, to be able to operate knowing that, hey, they're at least doing their best. Because I do believe that most of the builders in the industry are trying to do good for Bitcoin and the industry. And obviously there's a lot of select few who are kind of bad apples, right? But overall, you shouldn't penalize the good builders just because you want to prevent this handful of bad apples from actually doing things. And of course, sometimes the media overblows the fact that this is bad apples launching rugs or scam coins or whatsoever, right? So I think in that sense, I think we are still a ways to go. But I think right now, at least, the conversations seem to be spearheaded, led, and also like, I guess, accepted by the right people. And hopefully we can have like some progress in the next few years as well.
Thank you. Yeah, I'm also really interested in like putting up my Bitcoin as collateral. You know, like never selling, buying a house for like some collateralized Bitcoin, and really not parting with this real estate that you have in cyberspace. So that's really great to hear. I'm always asking myself, and since we talked about culture on Bitcoin earlier and what's necessary to basically convince people to go to Bitcoin. You touch on regulation and basically also mentioned tools and education. You know, I wonder, do you think this problem we have right now with liquidity is less than it was before, like 2021, 2022, you know, like, because obviously we have a different admin now, we have different laws. I think personally people should feel more secure in their Bitcoin holding, but right now the price action doesn't really show that. So I'm excited for you guys to like talk a little bit about the price volatility of Bitcoin and uncertainty towards like institutional liquidity providers.
Yeah, I guess like if you look back to that time period, in some instances, in some ways, there was actually more liquidity, but I would say it wasn't good liquidity, where there's like a lot of rehypothecation, a lot of unknown or untold risks, or you know, backroom dealing and all that kind of stuff, which when unwound caused this, like, you know, that deep and long bear market that we experienced from 2022, 2023. I think we learn from those experiences, just like the regular financial system does. Like there's you know, booms and busts in the regulated financial industry too, and or like the traditional financial industry. And I think that some of the practices that enabled liquidity, like, you know, in the sense of being able to buy and sell, or you know, pledge assets very easily in those days, were not good for the ecosystem, in the sense where they involved you know, untold risks, and a lot of you know, outright deceit, I think, a lot of times, and like promising things that just were not true. And so I think you know, again, sorry to harp on this regulation thing once again, but you know, as we learn from that and some rules come into play, that allows people to be a bit more have a bit more confidence in a system, and then feel a little bit more willing to participate in this new and nascent ecosystem too, which will bring more liquidity into that. And I think like, you know, something that was mentioned before on the meme coin side of things versus like Bitcoin, like I think part of the reason why, well, there's obviously lots of reasons why Bitcoin's held up better than other assets in this ecosystem, in this kind of like you know, mini cycle that we're experiencing here, is that there's new participants in the Bitcoin ecosystem as we opened up to ETFs, and like that means that, oh, all of a sudden registered investment advisors are slowly starting to recommend. The BlackRock ecosystem slowly starting to recommend. You have new net buyers into the ecosystem. Hedge funds are now, you know, buying and selling at the same time, but it just that adds liquidity overall, versus like in some of the other less institutional ecosystems where you have some meme coins, for example, where you have like a net extraction of value. What ends up happening when a hedge fund unwinds its basis trade or whatever else, is that it sits on the sidelines and it might go back in, but it's like it's ready to play once again. Whereas I think some of the purely extractive behavior maybe in the meme coin space, for example, is people go in, they gets bid up, and then when they dump on like, you know, crypto participants, that money leaves and it doesn't go back. It's like it's going to a bank account. It's not trying to, you know, go and play in DeFi or do something else with it or whatever else. And so that causes a vacuum over there. And I think this is my hypothesis, is that that's what you're seeing over there, and that's why you have this like really deep, pronounced kind of like vacuum of capital in some of the non-Bitcoin ecosystem. Whereas Bitcoin, while experiencing some weakness here, has held up relatively well. And I think that's because its tailwind is more institutional in nature, and maybe longer lasting.
Yeah, I think my perspective on this is that I think this cycle, definitely the sheer amount of like dollar value that has like swing upwards and downwards from a volatility perspective is just the greatest that we've ever seen, right? So in that sense, Wall Street and actually a lot of traditional finance actually love it, right? If you look at like MicroStrategy, for example, The only reason why, I mean, not the only reason, but like one of the main reasons why they're able to raise so much convertible debt is also, and their playbook is really because of the volatility of their stock and also like the underlying assets and so on, right? So that actually creates a lot of excitement between the participants in the market, which also then makes Bitcoin and the other assets very interesting for investors, right? And of course, I've heard a lot of people talk about how they place these like either they short MicroStrategy, long Bitcoin, or like, I don't know, the reverse or whatsoever, and they kind of like do a lot of those trades kind of thing. So it's kind of interesting how those kind of like has been playing out overall. And I think like when it comes to a lot of the other activity, in respect to that, right? I think the market has also gotten a little bit more used to these like fluctuations, and that's kind of interesting, right? I think we've been in crypto for long enough to kind of be able to survive or at least go through a few crashes, if we may, right? It's like, oh my God, Bitcoin is crashed to 100K now. Oh my God, right? And so on. So I think it's kind of interesting that we've all gone through a little bit of that. But at the same time, I think it also has tie-ins with like the global asset class across the board. I think it's also kind of interesting that we're still actually in a quantitative tightening environment. We're actually not in a QE environment yet, right? So perhaps there may be more like incentives for that to happen in the future. And if that happens, that could also help drive a lot more interest for risk assets or like, store value assets or whatsoever, right, in that regard as well. So I think Bitcoin sometimes is perceived as a store value asset, sometimes perceived as a risk asset for some individuals in the community. So I think it really depends on, time of the day and so on. But I do think that in next year, we will see a more friendly environment for Bitcoin as an asset. Yeah.
Maybe just quickly on that, I have some really good points. It's like, I do think that an underappreciated element of like the crypto ecosystem more broadly is something that our CEO has mentioned a few times, where it's like volatility in crypto is like a feature, not a bug. And like, I think that's what like it captivates attention. It drives like people into the ecosystem. And like, you kind of lead with that speculation, and then it kind of like you can build things out on a more lasting basis afterwards. And I think that's like an underappreciated element of like what we're doing here. And like the cool part about being early in this ecosystem, like eventually as crypto grows and Bitcoin grows, it naturally will become less volatile over time. And we might harken back to the days of like, oh man, it used to be like, it was like, it was so much easier to make money or whatever else, right? And so like that is like something that we should kind of like lean into a little bit right now. And the other thing I kind of forget now, actually. I kind of got into that one. Yeah, I forget now.
It will come back to you. A totally different question in a different direction than regulation right now. Yeah. Would be, I've seen custodians popping up with services and ideas about like how to reduce the exchange risk for liquidity providers. There are things like Fortuna Reflect that allows people or institutional liquidity providers to basically use an intermittent custodian and at the same time still deploy the liquidity and reap the rewards. I think that's a really interesting development because you both mentioned that risk. How do you see these services fitting into the liquidity narrative? And I think it's a really cool thing to de-risk them, but I don't know how many people that weren't ready yet to deploy liquidity into Bitcoin would now consider it. What do you think about that?
Yeah, I think like custodians as a product has like really evolved over the last couple of years, right? Even like the fundamental architecture, of course, like back in the day was maybe like mostly HSM, but like I think these days a lot more like MPC solutions. There's more DeFi friendly and so on, like where Fireblocks and many of these other solution providers have started, right? I think like right now, if you look at a lot of the ETFs and a Coinbase, I think Coinbase custody is like the custody provider for many of these, and of course BitGo and many others as well, right? So I think overall, I feel like the investments and also from a talent perspective, from time perspective, and all of these infrastructure investments into custodian technologies has really paid off in a way that now I think institutions have so much to choose, right? That you can choose between like all these different service providers and you can really compare what they offer, right? And many of these companies are going out of their way to market, differentiate, and do a lot of work. And even within a Bitcoin space, for Bitcoin, for example, maybe like staking, for example, the Anchorage Digital team has been doing a lot of work in that space. Some has been a little bit less interested, but that's okay, right? I think it provides a lot of market opportunity because they could then focus on maybe other ecosystems as well, right? So because now crypto as a category is so big, we have so much opportunity for these providers to just focus on what they want to do, and then for smaller startups to also emerge, right? And it's really important, right? Without startups emerging to kind of solve these like more pressing problems that some of these smaller asset categories focus on, then what is the opportunity, right? If everything's eaten up by Coinbase, then what is the point, right? So I think in some ways it's really nice that a lot of like attention and also like as a category, investors seem to also understand this category now, and with these sort of things that have happened, it really helps to improve institutional demand, liquidity, and security, and also like just adoption overall, right? Because otherwise, if you think about it, if you have to self-custody your Bitcoin, I'm saying it in a way that I think self-custody is still very, very important. And of course, on the product that we built, like UniSat and so on, we really focus on self-custody, right? But of course, if institutions want to fit in their LP agreements and many of these other agreements that they have, then I think custodians actually do play a very big role, and it really helps to onboard more liquidity into Bitcoin together.
Yeah, no, like really well said. I think one of the things I've found pretty fascinating and sometimes entertaining, coming from like a long career in traditional finance and then coming into crypto afterwards, was like how sometimes like teams of engineers will reinvent or like invent things like maybe from first principles that have like existed for a long time in like traditional finance, but like with unique differentiation a little bit sometimes, or certainly different like nomenclature. But at the end of the day, it's like in the traditional financial system, you kind of have this like trust in the idea that there's a common regulator that says like, well, we kind of think that like these other players are operating under the same rule book as us, because if not, they'll get like in trouble from this top person, right? And that sometimes works, sometimes doesn't. We probably were all through like some of the financial crisis that we've experienced, and some bad actors were brought to light that way. But in crypto, that hasn't happened so far, and so we've had to use technology for those solutions. And so initially there was like really no trust, or we've seen instances of like where there was too much trust, like centralized exchange with failures and so on and so forth. And I think it's been really cool to see like that iterative experience happen, and kind of arrive at some like maybe better solutions than exist in the idea where like there's this like watchdog that's gonna like protect us all, and we've seen that fail time and time again. Whereas some of the more innovative custodian solutions, like you've talked about, where it's like, hey, I can attest my ownership and my financial strength to a counterparty, maybe just like using privacy preserving technology, like zero knowledge proofs or something like that, whereby they'll know that I'm solvent and I'm in a good place. They don't have to see exactly my financial composition or my wallet, so they can't be predatory and like force me into certain trades or whatever else. They just know I'm solvent and I'm good, and as a result, I have a certain cost of capital with them or whatever else. And like that's super interesting, and that like really does not exist in the traditional financial world. And like that kind of stuff will avoid blow-ups and other kind of like risk management snafus that we've seen in traditional finance. And that's like totally novel, and has come about through that kind of like engineering and engineering first approach from crypto.
Do you think that when we agree on the services basically being developed right now, or are available already, and we also catch up with the regulation right now, at least in the US, can't speak for Europe, but like is all that's missing then education, or is it just a question of time?
Like education's huge. Education, I think, is probably paramount, to your point. However, I do think that it is still important that we have really strict and very enforced kind of rules around disclosure, because people can be educated, but if we look at like the regular financial ecosystem, just a lot of people don't care about their finances, or like maybe we don't do a good enough job of teaching this in school, and that's a different discussion altogether. But people have to want to learn, I think, to a certain extent. You can't really force that on them. But if you force disclosure upon service or people who are offering products or services, then I think that makes a big difference. Where if someone's selling a financial product or like that involves crypto, has to disclose like what the risks are, or like can't say things like I promise you'll get this return, which hasn't been allowed in regular finance for a long time, but somehow was done in crypto for a while. Then that will set off like the person's kind of like spidey sense or like natural ability to like say, hey, wait a minute, what are you talking about? And like sometimes greed or lack of knowledge might jump into something, but if there are sufficient kind of regulations around like what can and can't be said, plus that like that push on education, then I think that's a huge step forward. And I for one am like always about that. Like I'm like I will champion that for as long as I'm here.
Yeah, I'll provide another perspective on this. I think what we're missing, and I think it's like, I wouldn't say missing in a word that we don't have it, is that we can have more of it. I think we can have a lot more retail interest. And retail interest and also like experimentation really drives institutional adoption. I know it sounds a little bit weird, but it is the case, right? If you think about real estate as an investment class, right? Because people want to live in these like nice places, that's why now like REITs or whatever, like BlackRock or any of these companies would then like buy these things and then rent it out to people who want to use them, right? And for example, in countries like India, where individuals really like gold, then like there's many gold funds that kind of like are like custodying gold as well. And if you think about it, many times when people ignore Bitcoin, it's really the retail interest, right? Maybe it's in ordinals, maybe it's in roots, maybe it's in BRC20s, maybe it's in like other like Bitcoin assets that then spark a lot more excitement about it. And then institutions are like, oh my God, I should pay attention to this, right? People actually care about it, right? It's going to be like interesting. So I would say like just putting on my retail product hat a little bit, I really do think that retail attention and interest really is the key driver for institutional demand, more than even education. Yeah.
Well, thank you very much. That was great answers from both of you. Thank you for holding up till this last panel. And before we are ending it and we're going into the DJ part and party part of the night, I want to open up the platform. Where can people find you? Where can they see more of your theories, theses, and products?
Yeah, so Aquanow.com is like where you can find out about Aquanow. Really just trying to help financial service businesses, take their crypto journey for the first time. And then I work on our asset management business. We've got like a venture and lending fund, part of that collateralized lending that I mentioned before. You can find me on LinkedIn, I guess, or we have some blogs that we do on Substack as well. You can probably just Google search that and then go from there. But I'll be around and happy to chat with anybody about any of this stuff, and I'm happy to learn from everyone here.
Yeah, I would just say like go to Chrome extension, iOS App Store or Android Store, download UniSat, try it out. And then like, of course, follow like Fractal on Twitter, follow Blockspace Force on Twitter, and then just pay attention to whatever everyone's building the Bitcoin ecosystem, right? Just like follow whoever you think is interesting. Go join the spaces, go look at the YouTube videos. Of course, like look at all these like sessions and so on that are like happening today. Yeah, and just get involved. Thank you.
Thank you for the chat, and like, have a great evening. Let's party it out.
Thank you.
Thank you so much.